So Tesla has been free falling recently. Even with the market going up, Tesla's still going down. In fact, Tesla's down 67% year to date. So because of popular requests, a lot of people have been asking me, Adam, is it time to buy Tesla? You used to say that Tesla is overvalued. Is it now undervalued? Is it now a great opportunity? So in this video, I'm going to break down my analysis of Tesla. Before I start, in full disclosure, I've been short Tesla for the last 2 months. And you guys who have been following me on social media would know that I've been short since early November. I announced it on my YouTube page over here. Yep. I can't resist shorting Tesla. And the reason I started shorting Tesla was because of a pure classic technical setup on the charts. If you take a look over here, you can see that this was a very strong level of support on Tesla at about $209. And in early November, it broke that strong level of support. So once a stock breaks a support level and it's on a downtrend, there's a high probability that it's going to go down. And that's the ideal time to short a stock. You can see that all the moving averages are sloping down. The 20 EMA is below the 40 EMA, short-term downtrend. The 50 moving average is below the 150 moving average. And it's below the 200 moving average. So everything is sloping down. So that was a very obvious no-brainer short position to take. So since then, the price has gone down quite a bit and I continued shorting the stock, and as of 2 days ago, I've closed all my short positions. Again, if you're on my Discord channel, you have to be a subscriber to get my live trade updates every single day. You can see 20th December, this was 2 days ago, I just closed my Tesla bear call spread trade and 90% realized profit. So why did I close my short trades on Tesla? It's because I think that short term, the price is a bit oversold and due for a relief rally, due for a bounce. So again, when you look at charts, remember that even on a downtrend, so Tesla's on a downtrend, but remember that on a downtrend, prices don't drop in a straight line. They move in wave patterns. It's always wave down, wave up, wave down, wave up, and that pattern continues until you have a change in trend. So currently you can see Tesla is on a clear downtrend, and if you look at this pattern, you can see the obvious wave patterns here, right? So we've got a wave down, wave up, wave down, wave up, wave down, right? So after a strong wave down, if you're short, you want to close your short. You want to lock in the profit, because what tends to happen after wave down, you're going to have a wave up. You should have a bounce very soon, a relief rally. But again, you can see this 20 EMA, this red line, acts as a strong level of resistance. So if it bounces and it can't break that 20 EMA, then likely it's going to go down even lower. So that's an opportunity to, again, take another short position. So I'm going to see if we get another leg down. So question is Tesla a buy? Well, it depends on both whether it's a trading perspective or an investing perspective. Now, obviously, from a trading perspective, now it's not the time to go long on Tesla because it's on a downtrend. It's the time to short Tesla when you see a rally to a level of resistance. Remember, when it comes to trend trading, and I've taught this many times in my trading seminars, when it comes to trend trading, you only want to trade stocks with the highest relative strength, where their relative strength ranking is 85 and above. So currently, Tesla's relative strength rating is, let's check it out, it's 7 relative strength rating, and that is, of course, something you never want to buy. All right, you want to make sure that it's at least 85 and above to take a trend trade on Tesla. So, you know, on short term, you definitely don't want to go long on Tesla. Now, how about a counter trend trade? Some people say, hey, how about doing a counter trend trade where it's on a downtrend, it's oversold, but you're getting in anticipation of a counter trend, buying as it's oversold. And yeah, you can look at a counter trend trade. In fact, if you take a look at some of the oscillators, you can see that, yeah, Tesla looks a bit oversold. The stochastics are oversold, and it's right at the lower Bollinger Bands. So yeah, you can anticipate a bit of a bounce up to take a short-term bounce trade. quick swing trade. But for that to happen, you need to see kind of like a double bottom setup. You need to see a bullish candlestick pattern. So, I don't see it yet. All right. So again, in trading, remember that just because you close a short doesn't mean that you go long. Okay. So now it's not the time to short. It's time to close the shorts, but it's not time to go long yet from a trading perspective. All right. So that's from a trading perspective. Now, let's go on to an investing perspective. So remember the difference is that when you make an investment, you're taking a long-term view. So when I invest in a business, whether it's an Amazon or Microsoft, I'm taking a view of holding the stock for at least 5 to 10 years. All right. So is Tesla a good investment from here? Because is it undervalued enough to make a good investment? So let's take a close look. So first of all, those of you who have been following me, you know that I never bought Tesla. For a few reasons. The first reason is because Tesla was way overvalued. It's overvalued by like 300%. Okay. Now, but since the price has fallen, is it still overvalued? Or is it now undervalued and an opportunity to buy for a long-term investment? So I'm going to run through that with you guys. So that's the first thing. The second reason I never bought Tesla is because in general, I never liked companies within the auto industry or the airline industry or the shipping industry for that matter. And the reason is very simple. These industries, the companies tend to have very high maintenance capex. They've got a lot of fixed assets and they have to spend a lot on capital expenditures to maintain their operations. It's very capital intensive, which I don't like, right? Why? Because when a company is in a very capital intensive industry, every time they sell a product, it costs a lot to make the product. Like, for example, cars, right? You sell a car, it costs a lot to make a car, okay? Whereas if you sell software, for example, like Microsoft, does it cost them anything to sell another software? No, because once they develop the software, people buy the software, every additional sale is zero cost, right? That's what I like about it. Same thing with, for example, Alphabet or YouTube. The more people that advertise on YouTube, is there more cost to the sale? No, the cost is fixed. Every additional sale is incremental profits. Same thing if you invest in Visa or MasterCard. Their infrastructure payment gateway is fixed. So every time you swipe your MasterCard and Visa, they are making fees. There's no additional cost. Whereas in the auto industry, for example, or shipping industry, there's costs involved to make that product, which I don't like. Yeah. The other reason why I don't like the auto industry in general is because you don't have recurring revenue. I mean, once you sell a car, when's the next time they buy another car? Yeah, maybe 5 or 6 years later, right? But if you invest in, for example, Visa, MasterCard, Microsoft, it's recurring revenue every year because you have to keep paying for subscriptions. So I prefer companies with recurring revenue and not so much companies where it's like a one-time sale and they have to hope that you buy again in a few years. Another reason why I don't like the auto industry is because it's very, very competitive. There are so many competitors, and because it's very competitive with high maintenance capex, profit margins tend to be very, very low. And historically, the auto industry has not been a very profitable industry. So I've talked about this before, but I want to give you a background to this. If you look at the auto industry, when it started in 1919, there were 2,000 US car manufacturers. 2,000 companies competing in that space, right? And it got smaller and smaller and smaller over the years. You can see that most of them all went bankrupt. And by 2009, you had only 3 left. General Motors, Chrysler, and Ford, of which Chrysler got bought over and GM went bankrupt but emerged from bankruptcy. In the current day, there are only 2 left. So think about it, from 2,000 to 2. Okay, and out of the 2, they are not very profitable as well. And of course, we had Tesla that joined the auto industry in 2008. Now, you may be saying, but Tesla is different because it's in electric vehicles and they don't really compete with the rest. And Tesla's like a market leader. It's got like 70% market share in the EV market, which is true, which is correct. So in the early days, they have got this huge market share, very good profit margins, and no competitors. But the question is it sustainable? Is it sustainable? In other words, 5 years from now, 10 years from now, because as an investor, you got to think 5 to 10 years from now, can Tesla continue to have this 60, 70% market share? Or will there be more and more companies also producing electric vehicles and flooding the market? And so in the end, everyone's margins will come down. And it's going to end up like, again, the auto industry in 1919, where almost everyone can't make money. Is that the case? So that's something that, let's explore in this video. So this is the second reason why I didn't buy Tesla, because it's in a very competitive industry. Again, I didn't look at it in the short term. I'm looking at it in the long run, because again, I recognize that in the short term, Tesla is a market leader. They've got like 70% market share in EV, right? But 10 years from now, I'm not sure they can maintain that leadership position, right? The third reason I never invested in Tesla is because of huge Keyman risk. Now, what does that mean? The trouble with a company like Tesla is that its brand is really, really strong, but the brand is tied to the reputation of a leader, like a cult leader, right? Like Elon Musk. And Elon Musk is very loved around the world because he's known as kind of like the real life Tony Stark. And that's great. Because of that, Tesla has got a great brand. People love buying Tesla because it's like cool. It's really cool to own a Tesla. And Tesla didn't have to spend any money on advertising, and they became the market leader because of the Elon Musk brand. Now, the trouble with that is that it's a double-edged sword. When your entire company's brand is affected by one man, if that guy gets hit by a bus, or if that guy goes nuts, right, his behavior goes erratic, then it's a double-edged sword. The whole brand of that company can go down the toilet, and that's what I call a Keyman risk. So personally, I like to avoid investing in companies where it's very dependent on one man, because again, if that man dies or that man goes nuts, the whole company goes to shit. I like to invest in companies where no one knows who's the CEO. For example, I invest in McDonald's. Do you know who's the CEO? Probably not. I invest in Visa, in MasterCard, in Nike. Do you know who's the CEO? No, you don't. Probably not, right? Or Pepsi, you don't know who the CEO is, right? So even if the CEO dies, gets hit by a truck, or goes into a sex scandal, you don't care, because the company is not dependent on that man. And if you think about it as an investment, you want predictability. You want something that can be sustainable, so you don't want to be tied to one man, all right? And that's another reason why, as much as I love Warren Buffett, I follow his philosophies, I wouldn't feel comfortable investing in Berkshire Hathaway right now, because a lot of it is built around this, again, cult status of Warren Buffett. And the guy's like 92, if I'm not wrong. And, there's a limit to how long he can live. The day he drinks his last can of Coke, and he's gone, Berkshire, they could have a big crash in the stock price, even though it's a great company, you got great managers, but, that cult status is gone. I remember what Peter Lynch said many, many years ago, the legendary fund manager. He said, Peter Lynch said this, he said, the best kind of companies to invest in are companies where any idiot can run it, because eventually an idiot will run it. So if you think about it, a company like, for example, Hershey's chocolates, any idiot can run it. Visa, MasterCard, any idiot can run it, because the moat is so strong, the brand is so powerful, that even you put a monkey there, it doesn't matter, okay? But if you have a company that's dependent on this great founder or great guru, that's really dangerous, because without him, there's no company. So those are the three reasons why I never invested in Tesla. Okay, but then looking forward, remember that as an investor, you got to be very, very flexible. You can't say, okay, I'll never invest in this, because if the thesis were to change, if facts were to change, it may now be a great investment. So I've spent a bit of time doing a bit of research, and I'll share with you my perspective on Tesla and whether I think that it's now worth taking a look at, whether it's worth making an investment for the long run. So let's take a look at the fundamentals of Tesla. Let's begin by looking at the revenue, profits, and cash flow from operations and free cash flow. So you can see that Tesla revenue has been growing very nicely for the last 10 years. And yes, it was unprofitable for the first couple of years, being a relatively new business. But in the last 2 years, it has become very, very profitable. You can see net profit positive in the last 2 years. In terms of operating cash flow, it has been generating positive operating cash flow for the last 4 years, positive free cash flow for the last 3 years. So it is very, very profitable. In terms of profitability ratios, the return on equity is 33%, which is really great. Anything above 15% is excellent. The return on invested capital, ROIC, is 27%. Again, really, really great numbers. Anything above 15% is excellent. So it is a very profitable company. The profit ratios are really, really excellent. And the debt ratios are very conservative as well. You can see that debt to EBITDA ratio is only 0.36. As long as the debt to EBITDA is 3 or less, it's a conservative business. And this is like 0.36, which is really, really safe in terms of the company won't go bankrupt because it's got it's got very little debt that it can cover with its profits, all right? In terms of interest coverage ratio, 54 times interest coverage, really very safe. Now, what is impressive about Tesla is that the company has got very high gross profit margins and operating margins in the context of the automotive industry that generally, like I mentioned, has very low margins because it's very competitive with a lot of high maintenance cost and high production cost. If you take a look at Tesla's competition, again, not just in EV, but across the board of all the auto manufacturers, you can see again Tesla, gross margin 26%, operating margin 16%. Now take a look at all its competitors. If you look at General Motors, gross margins 12%, operating margin 6%. Ford, gross margins 15%, operating margin 7%. NIO, still unprofitable. Rivian, still unprofitable. Toyota, look at Toyota over there, gross margins 16%, operating margins 7%. So here's the thing. If you look at the whole industry of auto manufacturers, the best ones, Ford, Toyota, General Motors, the other market leaders in autos, their average gross margins are 13 to 17%, whereas Tesla is like 26%, way above the average, all right? Operating margins, the average is 6 to 7%, but Tesla's 16%. So looks really, really great. But the question to ask would be, is this sustainable? Can they sustain this in the next 5 to 10 years? Now, the reason they're able to have such high margins now is because they are the clear market leader in the electric vehicle industry. They've got, at one point close to 70% market share. So when you're the market leader, you can have very high margins. But if in the next 5 to 10 years, more and more competitors come into the EV space and they have to compete with all these people and they have to give bigger discounts because of the competition or for some reason their costs go up, then their margins may not be sustainable. Their margins may come down to the industry average eventually. And that's the risk of this investment. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.